Good morning, Jeremy. How are you?
Morning, Anil. I'm very well. How are you?
Excellent, excellent. Thank you. So, just by way of introduction, Jeremy is a co-founder and portfolio manager at Ardevora Asset Management. Ardevora managed the Net Group Investments Global Behavioral Fund, which is a diversified portfolio of about 150 to 250 equally weighted stocks. Now, Ardevora use fundamental techniques to identify unusual behavior in global equity markets, and they actually look at the way company management, analysts, and investors make decisions, and particularly the circumstances in which they tend to make mistakes. Their portfolios include a combination of both growth and value names, depending on where they're currently seeing opportunities in the markets. So, Jeremy, I guess no slides for this session. We're just going to jump straight into questions. But just so that our viewers online are aware, since launching the strategy in 2013, Ardevora have handsomely outperformed the MSCI Acqui Index and the Net Group Investments Global Behavioral Fund, which Ardevora have been managing since inception, is actually coming up for its 3-year anniversary now, which is really fantastic. So, Jeremy, I'd like to kick off and just give you the opportunity to maybe share with us a couple of interesting examples, and particularly how they fit in with your investment philosophy, please.
Yeah, thanks, Anil. I thought what I'd do is focus on a couple of types of stocks and industries that are quite intriguing from a kind of long-term behavioral cycle, and are a little bit different to maybe some of the things that we've talked about in prior interviews, because these are more areas I think where it's quite easy as an investor or an analyst to feel uncomfortable about the industry or the stock that's in it, and I think exploring the psychology around that is sort of quite intriguing, rather than, if you like, focusing on the exciting growth opportunities which are out there. I thought it would be kind of fun to go through one of the banks that we own. Because that has quite an interesting the whole industry has quite an interesting history, and also go into the tech sector, but with an area in tech which again has a history of tending to make people feel uncomfortable, and why there's some interesting error, I think, to be found there. So we'll start with the bank. We've got a few banks in the portfolio. We introduced our banking exposure sort of about around March, April of last year, having been very skeptical about the banking sector because of the problems of the financial crisis and the risks that sort of created. I think in many ways, there's an interesting parallel between banking and the tech sector, in that the banking sector almost had its own sort of TMT, sort of boom bust kind of cycle. Because as we all know, the last financial crisis was sort of triggered by aggressive growth and risky behavior by banks. And then they've had their sort of equivalent of the lost decade, where they've had to retrench as an industry. A lot of the reckless and risky CEO behavior, which sort of drove a lot of the problems, has been sort of squeezed out of the system. And the whole industry has sort of, in a simple way, I think, been de-risked. And so it presented, I think, quite an interesting opportunity in that sort of long-term behavioural cycles that intrigue us. So we went hunting for what we felt were some interesting banks at the start of last year, and we found a few very interesting ones scattered around the world. Most of them actually are more kind of growth orientated, and the one in particular, a New York-based bank called Signature Bank, I think sort of typifies what the kind of business that can thrive against this sort of interesting background. Signature Bank is in many ways a very old-fashioned bank, and it places a lot of emphasis on strong customer relationships and face-to-face customer relationships as well. And they have a very strong franchise amongst the legal profession in New York, but also they're a relatively modern bank in that they've put in, they're not hampered by old, sort of slightly rubbish IT systems. So they've sort of embraced technology as well. And so the combination of those two led to a very unusual pattern of behavior during those, if like that crisis, that lost decade, because they found it relatively easy to keep growing loan growth and staying profitable, and weren't hampered by many of the issues that their competition have. So it's a very unusual looking business in a, if you like, a kind of tricky, anxiety-inducing industry, which I think is sort of emerging into potentially a more interesting environment. The other one is a semiconductor business, but it's involved in making the bits of machinery that then make the chips that everybody gets excited about. Now that industry is, I would say, less fashionable, and it's a harder to predict industry. You know, the capex cycles swing around wildly. It can be easy to misforecast them. And so that industry is tended to carry a bit of a stigma compared to the more sexy areas, and often sold on much lower valuations. They also had a very painful period for about 15 years after the TMT boom, where just people just didn't spend anymore. But as I'm sure you've probably heard from other growth managers, the semiconductor industry is really intriguing now. There's many more opportunities for growth, but within that, there's very tight supply constraints, and the enablers, if you like, of allowing a lot of other businesses to do well are these semi-capex businesses, and Applied Materials is a very good example of that. And I can see, Anil, you're looking a bit twitched because I'm doing my usual trick of talking too much and running over time, so I'll pause there.
Well, not actually. I was actually just thinking that I know that you and your team have put in quite a lot of resources into the banking sector. And I can actually see that knowledge base and expertise coming out. So I was actually quite impressed and quite pleased. So Jeremy, maybe just to continue then, because I mean, this question I really have to ask you because just the way you manage money and your philosophy, I think it just ties in so well. But particularly in the current environment, whose behavior really sticks out for you? Is it management? Is it analysts or investors?
Well, I think so. Usually, I would say that we focus on management behavior because that's where we see a lot of the risk comes, and then we focus on analyst behavior because they show you, if you like, where the mistakes are being made, and then the combination of those two often drive investor behavior, if you like, and that kind of approach, I think, sort of fits this our idea of sort of kind of in a kind of basic way, starting from the bottom up, looking at what's going on in businesses, then building it up to an industry, and then maybe trying to draw some conclusions overall. But I think what was really intriguing about last year, and it was kind of bookended, I think, by the start and then the end of the year, was the kinds of things that gripped investors' attention and how that shifted away from, if you like, what was going on down at the stock level and moved up much more at the macro level. Now, we know we've been in a very unusual environment macro-wise because of the COVID shock, but I think what was really interesting for us out of last year was that actually almost very concentrated, almost like January and December, what kind of gripped investors' attention. And in January, what gripped them was that sudden realization that we're beginning that path to normal. And normal means a lot of things in this world. It means normal behavior, not being in lockdowns, but it also means a return to normal ranges for a number of economic variables that went kind of haywire. And in January of last year, one of those economic variables that had gone haywire were interest rates and bond yields, which were unusually low. And they did a quick spurt up in January of last year. And that led to a certain type of stock gripping investors' attention, and also some anxiety about valuations and some other stocks. So we had a short, sharp value rotation, if you like, at the start of last year. At the end of last year in December, investors' attention was gripped by inflation, and that was mainly because of the sudden about turn that the Fed's behavior took, where it had taken a very relaxed attitude to inflation through the year, but suddenly they signaled essentially their conviction that inflation was potentially a problem, but more again, it was to do with this, what's the path to normal? I think what the Fed was signaling was that they really had confidence that the economy was going to return to normal. And that led to, again, a kind of a shift in investors' attention around valuations and what that sort of meant. Now, the context for us is that normally, when the economy is in balance, which is most of the time, when analysts get surprised, investors get surprised, investors like surprise, and so they tend to reward surprise, and they tend to reward that by higher valuations. Last year kind of wasn't like that. If you like, analyst behavior and investor behavior almost moved in the opposite direction. And I think that's the setup for this year. I think we're on this path, economic variables heading back to normal, and part of that is getting interest rates back to normal. And I think despite the fact there's some super interesting structural growth trends, our suspicion is that investors' attention, while we're going through that transition, may be a little bit more concerned with where things like interest rates should be and where they should end up, and that could, I think, cause some interesting shifts in valuations.
Jeremy, that was brilliant as always. Thanks very much. Whenever we have a chat, I always feel like I've learned so much by the end of it. So thank you very much for your time today, and we look forward to speaking to you again soon.
Brilliant. Thanks very much, Anil. Take care.
Thank you.